want to dwell on the real basics because all of us kind of know them. We'll go through them real quickly because I'm not going to leave you lost. But I want to get over to how we use candlesticks in the real world. Because most new traders learn a little bit about candlestick analysis, but most of what they learn is completely useless. Now, when I started trading in the 70s, very few people use candlesticks, even though they've been around for 700 years, because we had to chart by hand. And drawing the candlesticks and coloring them in and making it was very time consuming. We all used bar charts. We carried around a single pencil and we're sitting there in a bullpen, basically, and we're drawing on our charts. So we didn't trade many assets, and we're all drawing on our independent charts. But the world was a slower pace. The market was a slower place. But a lot of people are taught about pattern recognition. And the standard approach to candlesticks analysis is basically with pattern recognition, which fails to work in real-time trading. But you can't skip straight to the advanced stuff without getting some basics. So I'm going to get you covered first, and then we'll go from there. Because what it's all about is price action. And all the information is reflected in the price. Buyers and sellers move markets based on expectations and emotions. Markets fluctuate, and the actual price may not reflect the actual underlying value. Now, each candlestick represents a data set for the complete price action during that selected time period. So in other words, if you're looking at a chart and you're looking at a 15-minute chart, that candlestick on that chart represents that last 15-minute segment. And you get the open, the high, the low, and the close. Okay, that's pretty straightforward. So we would put a dash across at the open, a dash across at the close, and if we step down from the open to the close, that was a bullish time frame. We put a dot at the highest point it went, and a dot at the lowest point it went, and we connect those dots to the lines, and these are known as wicks, and this is the body of the candle. Now, whether you're using bar charts or using candlestick charts, they contain the exact same information because all that you have to work with is the open, the high, the low, and the close. So as you can see on this candle, if it is a bullish time period, means the price went up from the open to the close, today we would fill it in green. And so when you see the charts with the green candles, that's telling you it's a bullish segment. When you fill it in with red, means the price opened here and closed down here. You step down the ladder, and that's a red period or a bearish period. Now, I have to explain something to you because I mentioned to you just briefly that when I first started trading, we did hand charting. So we didn't have colored candles because all we had was our pencils. So a lot of times you'll be reading reference material or you'll actually see names of candlestick patterns that refer to black and white. Okay. When it was a bearish session, since we didn't have magic markers in those days and we didn't have computers and we were using a pencil, in a bearish session, we would just use the side of the pencil and fill in the candle. So when we see it referred to as a black candle, that means it was a bearish session. When you refer to it as a white candle, that means we just left it empty, and that was a bullish session, which today we replace with greens and reds. But in the same respect, I've seen some brands and some charts on their brands that use their company colors. Because as long as you know which is bullish and which is bearish, and today all of our charts allow us to adjust everything we want. So let's let's bring up a live chart and I'll show you this. And then I'm going to share with you quickly. Let's get some. I just want to clean up my highlighting. Okay. Now we're looking at my standard teaching chart in a second. This is the Euro US dollar chart. Okay. And we can see all these red and green candles. But the fact is, like I said, we can click on settings And we could change the bodies and the wicks of the candles, and we could use purple and orange, green and red, blue and white, whatever suits your fancy. Okay. But it's just whatever, knowing whatever color is your bullish and whatever color is your bearish candle. Now, too many new traders think that when they see lots of green or lots of red, prices going up or down. Now, the candles tell you the last session was bearish, and you could have a lot of bearish sessions in the middle of an uptrend. It doesn't tell you what to trade. So don't get confused and don't get yourself involved in all of the reds and the greens you see in candles. Candles are about the story of pricing candles, which we'll talk about in a second, is about the body of the candle and the wicks of the candle. See, sometimes we have small bodies. Sometimes we have ridiculously large bodies. Sometimes we have things that are known as indecision candles. Sometimes we have engulfing candles. Sometimes we have long bars. These all tell us something about the battle between the bulls and the bears. Okay, it's not about how much red and green you see. So we also have candlestick charting. Now, what we're looking at is a simple candlestick chart. This has got nothing to do with using candlesticks in your trading. This is, instead of looking at a bar chart, we can look at where's my bar charts? There we go. Instead of looking at a bar chart, we look at the candlestick, because people like reds and greens. But in fact, today, our new modern charts would allow us to almost do the same thing with a bar chart as we do with candles. Because today we're getting such advanced charts that sometimes they give us too much stuff, because this drives my eyes crazy, because I'm used to bar charts being black. I'm used to candles being black and white or red and green. But we can also jump from one to the next. It's what we get in this modern world. But this is just charting. This isn't reading candles. It's not reading the price. It could be your preferential use of a chart, because I like using candlesticks to draw my trend lines. I can see better how price is moving. Okay. The colors and the wicks help me see things that I don't normally see in bar charts. So you could use a candlestick chart just as for its charting ability. You can use candlesticks for just pattern recognition, or you can use candlesticks in your trading strategy. So there are many different degrees in which you can use candlesticks. So like if we click up here, you can see an entire candlestick trading strategy incorporating consolidation and the wicks of the candles and the movement of the candles to trade between the support and resistance. It gives you a nice combination of candles with other pieces of information or other analysis to come up with a trading system. Or here we simply have the use of candlesticks with technical analysis indicators without using any candles. Now, I did mention that a lot of people teach you pattern recognition. Okay, so pattern recognition is this. I need to get it up on this. Is pattern recognition, which is, come on. It just doesn't want to put the screen up there for you. Okay. Let's go back to my PowerPoint and I'll show it to you from there. Pattern recognition is looking at come on, boys and girls, here we go. Is looking at patterns with names. Hammer, inverted hammer, dragonfly, doji, spinning top, shooting star, and memorizing exactly what these patterns should be, and then exactly what you're supposed to do when you see this pattern. So this worked well years ago in the stock market, even in the commodities market, when the markets move slower and we could see these patterns unfold. Okay. Today, it's really kind of useless for us. Now, if you look on your screen, I gave you a cheat sheet. It's if you see on your screen, it says Candlestick cheat sheet. You can download it. Just click on the button, download, and I gave you a beautiful display of all the patterns you're supposed to memorize and what they tell you. But believe me, it's not worth your time. On top of it today, we have modern computers that can help us with this also. See, like we're using TradingView, but you can also do this on almost all advanced charting services. We just go look up candles. So I've got my bullish engulfing, I've got my bearish engulfing, I've got my harami, I've got my marabou. These are my favorite patterns. And I can just tell the computer when they develop, tell me. And so here I can see a bullish engulfing candle just developed here. I can actually put my highlighter on there. And it tells me exactly what it is and what I'm supposed to do. Mindless trading. Please don't. That's why I'm saying most of this is useless. But today we've gotten a good deal of it. We've computerized it all. And you can easily get it if you want to trade any specific patterns. But that is a bunch of memorization. It's like when you go to school and your teacher holds up all those flashcards and you're supposed to memorize. 2 and 2 is 4, 3 and 3 is 6, 6 and 6 is 12. And she holds up the flashcard and you're just memorizing, but you never learn to add, divide, and multiply. But you do have to start somewhere. Okay. So it's a good place to really kind of start getting used to candles. But it really is not going to help you in the long term in your trading. But you have to know the basics. Because without it, then you're just kind of lost. So, because this is not candlestick analysis, it is pattern recognition. And for a price action trader, which I am, and which most of you will be, it's useless. Actually, it's kind of worse than useless. Thinking about candles as just patterns is counterproductive. It makes you a worse trader. It leads you to make massive mistakes. Why? Giving a pattern a set definition leads to tunnel vision. If I tell you when an indecision candle appears in an uptrend, trade it this way, and you stop looking at all the other, you just do that, you're going to end up losing more than you're going to ever being successful because you're making untrained, you're not looking far enough because you're getting stuck in this definition. Because that's not how candles work. All candles need to be assessed based on the candlesticks around them as well as many other factors. So the truth about candlestick analysis, normally people say that a spinning top means a reversal is imminent, which can be true. However, this same pattern can also mean that a continuation is imminent. It can be that the price is just temporarily stalling. It can mean a lot of different things. So thinking of candles as simply a pattern is a wrong way to do things. You need to look beyond the pattern and read the story of price. So before we go on and start reading the story of price, I'm just going to show you a little presentation I put together to sum up all the things we've listened to over the last 30 minutes to make sure you have them all down packed, because then we're going to get into the good stuff. And that's how to trade and how to use it, how to use candlesticks in your strategies.
Candlestick chart. Get to know the main chart patterns. You probably think that financial analysis is complicated, but it actually comes down to two simple things: reading charts and reading news. There are many types of charts, but Japanese candlestick, or simply candlestick, are the most popular ones. Such a chart consists of red and green candlesticks or candles lined one after another. Each candle gives you detailed information about the price movement within a specified time interval. In fact, Japanese candlesticks are the best way to visualize the ups and downs of a price so that you can spot potential opportunities to buy or sell. Let's take a more detailed look. Every candle consists of a body and one or two tails called shadows sticking out of it. The body indicates the range between the open and close price for a specific time frame, and the shadows represent the highest and lowest price levels reached for the set interval. Japanese candlestick charts are easy to read. A red candle shows that the price is going down, and a green one represents an increasing price. If you're looking at a 10-minute chart, each candle represents a 10-minute time interval. We see a green candle when the open price is lower than the close price. If the price closes lower than it opened, then the candle is red. As simple as that. What kind of signals does a candlestick chart provide? It's no surprise that candlestick charts are so popular. They're excellent for spotting market turning points. By looking at the patterns that candles create, you can often guess if a certain market is about to continue in its current direction or reverse it. Patterns that show that the market could change direction are called reversal patterns. They could be bearish, ones that indicate the change from an uptrend to a downtrend that should be perceived as a signal to sell. Or bullish, these show that a price that has been decreasing is likely to start going up and we should buy. Let's see the most popular candlestick patterns which encourage you to buy. Bullish engulfing. The bullish engulfing consists of a red candle followed by a bigger green one, which fully engulfs the red candle. The pattern is an indication for a market turning point. In simple words, it's likely that the market may start going up and you can buy. The indication is even stronger if the green candlestick engulfs 2 or 3 red candles. Hammer. The name of this candle is pretty much self-explanatory. You'll recognize the hammer by its short body, lower shadow that is about 2 or 3 times the length of the body, and a shorter upper shadow, or no shadow at all. The hammer is usually a clear indication of a declining price reversing its direction and starting to go up, so you can start buying. But just to be safe, you could always wait for additional confirmation. Such confirmation is a green candle closing above the open of the hammer, for example. Morning doji star. This pattern appears when there is a slight market movement and consists of 3 candles, a red one, followed by a doji, followed by a green candle closing beyond the middle of the first candle. If the green candle is longer than the red one, the signal is even more reliable. Spotting the morning doji star is a signal to buy. Some chart patterns that mean you can sell. Bearish engulfing. This pattern is the opposite of bullish engulfing. A green candle is completely engulfed by a following red candle. When you spot it, you can sell, as the sellers on the market have possibly managed to overpower the buyers and the price direction could reverse. Dark cloud cover. The dark cloud cover appears before the price drops down. A long green candle is followed by a red one that opens at a new high and closes below the middle of the green candle. Keep in mind that when trading currencies, a second candle opening at a new high is rare, so the red candle usually opens at the close level of the green one. Once you see this pattern, you can go ahead and sell, or you can wait for another, smaller red candle to form and confirm the dark cloud cover. Shooting star. The shooting star is a red candlestick with a small body, long upper shadow and a short lower one. When it appears at the end of an uptrend, it shows you that you can sell, since the price, which has been rising up to that point, may start falling instead.
So as you can see, it's a whole bunch of memorization of all of these little things called morning stars, evening stars, 3 white soldiers, 3 black crows, hammers, engulfing patterns, and it goes on and on and on. But the truth about candlestick analysis, it's really How do you use it to interpret the story of price? Now, every single candle on your chart is telling you a story. When you combine those candles together, you get the story of price. So the foundation for my trading strategy is reading and understanding the story of price. Reading and understanding the story of price is vital in Forex. It's vital because it allows you to know who is in control of the markets. Now, the price only has three possible outcomes: buyers, sellers, or neither. But being able to accurately answer that question is vital. If you're about to enter a short trade, you need to ask yourself, who's in control of price? Because if the answer is the buyers, then perhaps you're selling at the wrong time and it's not a good idea. So let's break down the story of price. So if you look here at these three highlighted candles, it's easy to conclude the sellers are in control of price. That's what, by just looking at the amounts of reds and greens, and three reds in a row would tell you, whoa, I should be trading going down. You should be selling. No, you shouldn't, because you're just guessing at that point. But the candles all closed lower than they opened. They created new lows beyond the previous candle's low, and they all had small upper wicks in comparison to their bodies. The small upper wick indicates that the buyers were unable to push the price up by much. But what does highlight and serve as something important is this yellow highlighted candle. You've got this major red move. You got this major bearish move, and then all of a sudden, you get something known as an indecision candle. An indecision candle is a small body candle that appears in a series of a directional move. It has a short upper wick, it has a small body, and a long lower wick. And this is what we call an indecision candle. So here, we're not dealing with dojis and engulfings and haramis and marabuzos. We're looking at what is on the chart in front of us. We saw a price running down, and we see this little tiny candle. And this little tiny candle is called indecision. It doesn't have a Japanese name. It's not hundreds of years old. It means that the buyers and sellers are become awkward at the moment. Indecision candles occur when buyers and sellers can gain and maintain control of price. They are common. They happen quite often. Believe me, they do. They appear in a trading day and a chart a zillion times. But if you understand how to use them the right way, they can be very powerful. So let's take a look at what happened here when we saw an uptrend. We had this run up of strong upward price movement. Okay, we had green candle after green candle after green candle, but then we got an indecision candle. That's telling you these buyers that were so strong pushing up, they haven't lost their battle. They haven't moved out of the market. They just sitting on the sideline for a second. But it also meant the sellers are sitting on the sidelines. So when price hits, now it's what comes important here is where it occurs, because they, like I said, they occur all the time. But when price hits a resistance level or a support level, depending on whether it's going up or down, and that's where the candle forms, we get a clue into how candles are telling us the story of price. So we've got this run up or run down in price. We've got on our charts our support and resistance zones. And we see, as we expect price to break through that support zone and keep on moving up, and break through that resistance zone and keep on moving up, what happens is it doesn't bounce off of it, but it doesn't go through. And what we get is this indecision candle. The large upper wick shows that the buyers tried to continue the bullish price but failed. Sellers took control of the price and pushed it down. So the small bearish body, though, shows that the sellers were able to close a slightly lower than the open. This is significant because in the three candles before the price consistently closed higher than the open. But it needs to have a small lower wick, or just the opposite if you're running off of a downtrend. Okay. The small lower wick shows us that sellers were not able to gain much ground either. This tells us that the sellers are not strong enough to turn price completely around. However, they are strong enough to stall the buyers any further. So let's quickly go look at a chart. So here we have our support and resistance areas moving up here. And as you can see, as we're moving down here, we get this small indecision candle right on our support level. And then price moves back up off of there. Okay. But it doesn't mean it can't move through. See here, broke right through. Here it broke right through. But when we get it directly on this level, we're getting a very important clue. What do we get here? Okay. Now, this setup must be entirely accurate. You can't guess at it. Okay. When you're looking at several candles, like here on this pound Canadian dollar, right here, look at it. We just got this run up in price. Now, if we had our support and resistance levels drawn on here, and then we were to get an indecision candle, let me slide this over a little bit so you can see it better. And we did. Look what happened. We got an indecision candle right here. Look, this is live charts. This is in the live market. 3 bearish, bullish candles moving straight up. Then we got the indecision candle right there, a beautiful formation. Okay. Now, it hasn't told us anything yet, except it's alerting us that we might have an opportunity. So, no, this isn't made up. This is in the actual market, so you actually see this happening. I mean, you can see here. And if we would have traded that bullish, the bearish indecision candle, we would have been able to trade it down here. Now, they don't tell you the trend is over. They tell you there's a short or a long opportunity just to take some money off the markets. But it has to be the correct setup, because what we're actually going into is most likely a short retracement and then back up. But then we can trade it down. Maybe it'll recur down here. We can trade it up. But we have to see the right setup, not fabricate it, not exhaust it. Okay. I'm just trying to get my PowerPoint back up here. So when we get the perfect setup, and doesn't this creative chart look just like the chart we just saw in the live chart? So altogether, this indecision candle forming right on the strong bullish candle suggests that a power has shifted from a decidedly bullish market to an undecided market, while sellers are not in control either. But there's one more thing we need to look at. The indecision candle is forming on top of a resistance area. So it's very important that that's how you interpret it. Okay, this is the story of price. We're using candles to analyze what the price is trying to tell you. Okay, so if you remember, we talked about resistance being a sell area and support being a buy area. So the image shows us 3 strong candles heading into resistance, and then what? Bam. Okay, we get the indecision candle, we get the short reversal. Price stalls, and we get indecision forming on top of that area. This tells us that the sell area is working. When price pushed in that sell area, it triggered sell orders, and buyers can no longer continue up. And that's the story of price on this particular chart. And this story gives us a nice little price action setup. Price action allows you to take many different types of trades. So this is only one of your strategies, one of your trade setups. And this is a reversal trade. So reversals occur quite often. But if you do not know what to look for, you can't trade them. Reversals are one of the strongest price action setups and one of the easiest to trade. In fact, for years, my Forex trading only focused on reversals. Now, reversals come in 3 parts: the preceding trend, or that move up, the indecision candle, and then the reversal trend. So again, the preceding trend is that move. It can be 3 candles, 5 candles, 7 candles. It can be intermixed with one of the opposite to the other, or 2 of the opposite color. But we have a price movement in a very specific direction. The preceding trend is very strong bullish. Okay, so we're not talking about trend lines. We're talking about using your eyes, and we can see. When we just looked at that Canadian dollar, the pound Canadian dollar, you could see those candles. We didn't make it up. You can see it. You just look at your eyes. There's no technical in this. So preceding trends are simple. If you see a strong move heading into an area of support and resistance, you can consider it a preceding trend. Then we need the indecision candle. That's a reversal setup. We have 1 to 3 indecision candles. Like we saw in the pound Canadian dollar, we had those 3 little tiny candles right after we had that boom. It doesn't have to be one indecision candle. So the indecision candle need to form on or near the support or the resistance area. If the indecision candle does not form on or near the area, support and resistance, it's not a valid reversal setup. Because like I said, indecision candles occur all the time. So an indecision candle in a bullish preceding trend indicates that buyers are possibly losing control. However, an indecision candle does not indicate that price will reverse. An indecision candle only indicates one thing: indecision. So you cannot take a trade solely on indecision. So that's why we have very specific rules, because you can see all these indecision candles occur. But when it happens during a trend and happens directly on the areas of support and resistance, then we can start figuring this out. And then the reversal trend is the third and most important part of the setup. So in this case, we saw the transition of power from bullish preceding trend to bearish. So where would you enter a trade, though? Now you have to understand, a good deal of your percentage of trades aren't going to be successful. Okay. But you can't wait too late to enter the trade, but you have to minimize your risk, because statistically, some of them will go in your favor, some of them won't. But as long as the ones that don't go in your favor are limited and you keep your minimum risk, you're all right. So my trading strategy was built on reversal trading. It's now expanded beyond that, but entering trades does not need to be difficult. My goal is to keep it simple. So it's about getting the timing right. So as I explained, the reversal comes in 3 parts: preceding trend, reversing trend, the indecision candle, and reversing trend. But this is where it becomes difficult. You need to practice this enough times that you believe in it. You need to enter the reversal trade after part 2, the indecision candle, closes. When you have that indecision candle, only 2 things can happen. Price can either fall and bounce down, or price can bounce right through it. But you know something's going to happen at this point. But if you wait for that next candle to bounce off of and break down, you're too late, because a good deal of your profit, because we're not going to make huge moves here, a good deal of your profit wouldn't be lost, but you'd be entering the market too late. So you need to make sure you do not enter too early, as it could also be a positive. So you have to wait for the close of that indecision candle. Not it's forming, not it's there. Okay. And otherwise, you can end up in this scenario right here, which happens all the time. But if you would have put your market order, the buy above the resistance, guess what? Your trade would have never actually taken place. It had never been executed. Okay. And even if it popped up there to where it was executed, bounced down, you would have set your stop loss right beneath your support, your support zone, and you would have popped out with a few dollar loss, but you would have popped out. So failed trades happen. There's nothing you can do about them. But getting it at the right time lowers your percentage of failed trades. Many people wait for a candle close to get in, but I have tested this thoroughly, and waiting for the closes gets you in too late. So you have to be ready to enter at the close of the indecision candle, and you want to enter slightly above the high of that indecision candle. Like I said, the market reverses and goes down, your trade will never be executed. And you would set your stop loss at the low of the wick of the indecision candle. Now, the key to reversal trading, or any trading, is a matter of getting in at the right time. So how do you do that? Now, I have tested countless entry methods for 15 years. When indecision forms on an area of support and resistance, you could use the high and the low of the indecision candle as a trigger and the stop loss. So your indecision candle, you place your stop loss here, your entry point here. So when the next candle forms, if it's a reversal, if it's not a reversal, and it goes the other way, either your entry will not be triggered and you'll never have the trade, or it might pop up there, execute it, but you'd get out of it at your stop loss. So let's say the minimum risk. Now you have to be able to set your targets. You have to use your own risk reward ratios and calculate where they would want to be, because you want to make sure your target is below the next level of resistance. If it isn't and your target is up here, you got to recalculate it, move your target below the next level of resistance, and then see if you can afford to make that trade and it fits your risk management. So in trading, a lot of people tend to overcomplicate simple concepts. Sure, some of the concepts of trading are not the sort of thing that you would intuitively know, but many things are easy. You could just know what you're looking for. So here are some basics on candlesticks. You got a heads up. You got to start. Now you can figure out. Now the Alvexo Academy has lots of materials. It's got webinars, it's got videos, it's got ebooks, it's got lessons, all on different strategies, different advanced use of candlesticks, and all training. It's all free. So just go to www.alvexo and go over their education. Their award-winning education platform. It's phenomenal. Okay, and you can learn everything you want. So my best advice to you is to set up a demo account at Alvexo. Doesn't cost you any money. Use their incredible platform, use their charts, do the demo trading, use their education center. And then when you're ready or you see how great it is, maybe you'll make a change from whoever you're trading with today, or maybe you'll decide you're ready to start trading. But Alvexo is where you should be. Thank you very much. Have a great trading day. And if you have any questions, just go to www.alvexo.com, click on the live chat button, and somebody will be glad to help you out. Bye now.